Hi, everyone. We're just going to let people log in and we'll just get started in a moment. Thank you. Okay, we're going to get started. Hello, everyone, and welcome to our event. My name is David Fulford, and I'm the CEO here at IPAC. And if there's one topic that I hear from leaders across our country consistently, it is around climate change and specifically around energy and how all governments are going to have to work together to solve this problem moving forward. So welcome to our event today entitled Leveraging Policy and Financial Tools for Accelerated Energy Transition. I'm so glad that you have joined us. IPAC has been around for 77 years, and over that time, we have not shied away from tackling some of the most difficult issues facing governments across the country. Today, you're going to have a chance to hear from some experts and a chance to ask questions. So I would ask you, if you do have questions, to please use the Q&A function that you'll see at the bottom of your screen, and you can just type them in and our moderator will hopefully get to them. If you can now just take a moment and using the chat feature, please let us know where you're participating from across our country. That would be much appreciated. I'd like to just now do a land acknowledgement, and with participants joining virtually from coast to coast, we acknowledge and respect the ancestral and unceded territories of all First Nation, Inuit, and Métis people. We acknowledge everyone here, encourage everyone here to take the opportunity to learn about the diverse and unique histories, cultures, and aspirations of the peoples on whose territories you work and live, and determine how you can take action towards reconciliation. IPAC is going to be celebrating its annual conference in Winnipeg this year, October 2nd to 4th. And if you haven't seen, we just launched a new program on values and ethics that will take place on May 30th. And if you participate in that, you may be eligible for a digital credential from the Schulich School of Business at York University. Now, I'd like to introduce our moderator. Nicole Wang is an infrastructure advisory partner at Deloitte Canada, and Nicole is going to be moderating today's session. And as I said, if you have questions, please put them into the Q&A function. Nicole, over to you.
Thank you, David, for that wonderful introduction. Hello, everyone. As David mentioned, my name is Nicole Wang. I'm an infrastructure partner focusing on government policy and strategic investments and building a more equitable and sustainable future. I'm really excited here to be moderating this panel. Thank you for making the time in your busy schedules to join us today. We know energy transition is more of a journey than a destiny. As we are identifying and navigating these various pathways, whether it's policy decisions at the macro level or investment decisions at the micro or industry level, we know the choices we make today will have far-reaching implications. So we must continue to learn, to listen, to build awareness, reflect, and pivot as needed. So let's hear from our panelists about their learning journey so far. Please welcome Kathleen Nocado, Jonathan Hackett, and Leslie Mitchell. Kathleen, would you start the introduction?
Great, thanks, Nicole. And thank you to IPAC and to Deloitte for the invitation to participate in today's discussion. I'm looking forward to it. As Nicole said, my name is Kathleen Nocato. I'm the Vice President of Strategic Engagement at the Public Policy Forum. We are a nonpartisan and independent think tank. And I can see in the chat that we have folks joining from across the country. We are pan-Canadian, and in my role, I have the pleasure of working with all provinces and territories, as well as every federal department and about 200 industry and civil society players from across Canada. My background is in energy and clean tech, as well as policy. I spent about a decade at the Mars Discovery District, where I worked with energy utilities, not only in Canada, but also in South America and the United States, particularly California and New York. And I held a role previously at Canada's permanent mission to the UN in New York, and have a master's from the Monk School of Global Affairs and Public Policy. So thank you for having me.
I'll go next. I'm Jonathan Hackett. I lead sustainable finance at the Bank of Montreal. My role really is focused on helping clients navigate the world of ESG, sustainability, and of course climate, and to look at how they can both raise capital for their efforts in that space, but also navigate investments and choices that they have to make as they pursue those goals. Prior to joining Bank of Montreal, was with the Boston Consulting Group, and before that was a theoretical physicist at the Perimeter Institute for Theoretical Physics in Waterloo.
Amazing. I'll go last. My name is Leslie Mitchell. I'm a director at Deloitte here with Nicole. I work out of our Calgary office, and I spend my days working with energy clients, doing economic evaluations of assets, cash flow models, investment decision analysis, really working through like where they're going to put their money over the next 10 years. I'm an engineer by training. That's my background, chemical engineering, and I've spent the vast majority of my career working with upstream oil and gas companies. But in recent years, I've had the privilege of really working with companies to develop decarbonization strategies, and work with to develop investment roadmaps and to achieve their emission reduction goals, and to work with our energy systems modeling team that's bringing the capability of Deloitte's financial and technical worlds together to really advise clients on energy transition investments. So I'm very excited to be here with you all today.
Great. Thank you all for the introduction. Now let's dive into it. We know there's been much debate already in the effectiveness of government policies and regulations on accelerating energy transition. If we may look into some perhaps tangible examples, Jonathan, perhaps I'll start with you. How has some of the government policies and regulations impacted on investments in energy transitions? We'd love to hear about from your perspective in terms of working with the investors and what you hear from them.
Yeah, fundamentally, we talk and compare the energy transition to the industrial revolution or other changes that have occurred in the past. But the major difference between the energy transition and any of these other revolutions, like the computer revolution or similar, is that it's entirely policy driven. Fundamentally, there are investments that companies will make in energy efficiency that you can say drive the energy transition, but more so, and nearly in all situations, the choices that are being made are informed by, are fundamentally underpinned by policy directives and policy choices that are made by different governments around the world. We live in a reality where, unfortunately, the costs of carbon dioxide are divorced from where they occur and where the carbon dioxide is generated within the economy. And so, without tools that either connect those costs, like carbon pricing, or that incentivize directly choices that are made, like structures in the Inflation Reduction Act in the United States, we don't see any driver of corporate action. There was a lot of discussion around purpose 5 years ago, and that driving a fundamental different approach for companies. And yes, investors are pushing on as a view of asset owners or asset managers that view the economy and the full health of the economy is beneficial to them. But none of that gets an IRR hurdle to make sense. And none of that motivates capital at the scale of what we've seen. And what that fundamentally means, though, is that the choices that policymakers make define the reality. You can debate the efficacy of the IRA, but the fundamental reality of the IRA in the United States is that if it doesn't have a bullet point on a list that says it has a 45 with a letter after it that generates a credit, then things don't get done. If a technology doesn't fit into one of those boxes defined by policymakers, it doesn't exist. And similarly, if the incentives derived by or the penalties created within a policy are insufficient to get over a investment return hurdle, investors aren't capable of making that decision in a way that reflects either fiduciary duty or their commercial interests. And so really policy is fundamentally driving all of this in the way that we've seen it unfold.
Thank you, Jonathan. I would love to come back to some of these realities later in our conversation. Before that, I'm going to go to Leslie next, because you've been advising clients, as you mentioned, and I'd love to the extent that you can share, what have you heard in terms of what's working and what may not have been working so effectively?
Yeah, I mean, I would echo a lot of what Jonathan said there, that the policy is fundamentally driving the investment case. So the combination of, let's say, the sticks and carrots that are available within or that exist across the landscape, whether those are ITCs for CCUS or hydrogen versus regulatory requirements for emission reduction with the proposed clean electricity regulations or the clean fuel regulations nationally. The CCUS ITC is a great example of one of the carrots that will make a huge difference to whether a project goes ahead, but it also isn't the only thing that's needed. The ITC is not enough for many projects that we've looked at to make it across that line. It fundamentally needs a carbon credit value to make it make sense. And so there is some movement in that policy space with the carbon contract for differences, but a lot of the decarbonization investments in heavy industry really rely on market for carbon credits that they can kind of really model and understand into the future to pull the trigger and get over those investment hurdles. And like Jonathan said, to make it make commercial sense along with the other investments available within their portfolio. So that's where I spend a lot of time really understanding like the specifics of the projects, what are the credits that you could generate, and then what's the potential outcomes in the market for what those credits could be valued at. It ranges all the way from 0 to quite a bit, depending on how you model it and where you think or what other investments are likely to also go ahead. I mean, that is kind of like policy is not done, or policy does not have impacts in a silo. It has impacts across the energy system. So there's a need to understand what's likely to go ahead in the rest of this system because it impacts the market that this individual project will be, or any individual project will be competing in and the price they can get. So that's sort of like the advisory work that we've been doing on the client side is not just on the regulatory requirements. It's all what's the market going to look like based off the policy that's currently in place and the likelihood of these other investments to go ahead. So.
That's great, Leslie. And I know, Kathleen, you also have some great perspectives building on that macroeconomic level. Can you speak to our progress, perhaps as a nation, and our competitiveness and strength?
Sure, thank you. So I want to start by acknowledging one of the recent and really incredible pieces of the federal budget, which is the Indigenous Loan Guarantees Program. When we talk about lessons learned, of course, all energy transition projects and investments run through First Nations land, and Indigenous communities, not all of them, but many have been looking to energy development, energy transition projects as a means to economic sovereignty and reconciliation. And so marks a massive step forward towards that. The First Nations Major Projects Coalition, through their research, has actually identified that there's a potential for over $526 billion of capital to be deployed through First Nations equity ownership and energy transition projects. So the $5 billion allocation through federal loan guarantees is a starting point. The fact that it was sector agnostic, it, of course, has been acknowledged as a real opening in terms of enabling First Nations communities to determine what kinds of projects they would foresee on First Nations land, and to really self-determine by looking at their field of options. So I think it's important to acknowledge kind of the opening that's taken place over the past few months in particular on that front. And maybe if I may, Nicole, just kind of pulling the camera back a little bit as well. You asked about the macro level piece. And I think for us at the Public Policy Forum, we've been analyzing what is actually required to get to net zero by 2050. And we've said, you know, there's been kind of this history of ragging the puck. There's been, and I think Leslie and Jonathan have mentioned this as well, the barriers and hurdles to a rate of return and to investment. And we need to move from ragging the puck to what we call hurry up offense. And this notion that the scale of the build and what's ahead requires just that fundamental shift in our mentality. I mean, I think about just on a generation basis in particular, right? We need 77,000 megawatts of onshore wind in order to enable an effective energy transition. We've built 17,000 in the last 3 decades. So when we look at the scale of what is required, it's really unprecedented. And I think it's also important to acknowledge that Canada has actually fallen in the rankings in terms of an ease of doing business when it comes to getting these projects done. We've gone from 4th globally in 2006 to about 23rd in the OECD in 2020. So falling to second last. And I'm happy to speak to some specific recommendations around how to rectify that later in the conversation. But for us, it's really hurry up and how to get projects done. So excited to dig into some of those recommendations.
That's great. And thank you for giving us some context in terms of the scale and what really needs to be done. And I know that, Leslie, you also have some thoughts as well around the realities when it comes to the scale and the pace at which that we are perhaps on this journey of transition. Are you able to add to that as well?
Yeah, I think Canada has committed significant funds to financing with tax credits and grants to foster decarbonization. I think it's in the magnitude of $83 billion in the FY23 budget, and new enhanced programs in the FY23 budget as well. But despite these financial and tax incentives, the policy complexities is a challenge across the spectrum of sectors. There needs to be decarbonization across the economy. So buildings by 2030 to meet the interim targets the federal government has put forward is 40% reduction in buildings emissions, 75% reduction in electricity emissions. Oil and gas needs to reduce by 40%, transportation by 20% at least. These are all significant challenges because as Kathleen mentioned, the movement has been much slower over the past few decades, even while we've had these goals in place, and we are, hurtling towards these 2030 interim targets. And I couldn't agree more with Kathleen's point of investments need to move. So almost whatever needs to be done. So the what needs to be true conversation is front and center, rather than this is a challenge, this is something that's not surmountable. It is surmountable. We just need to understand what needs to be true so that we can put those in place. To add to Kathleen's point about the scale of it, the Ontario Electricity System Operator has estimated that the cost of transition for their system is $400 billion over the next 20 years. That's half of Ontario's current GDP. So the scale is large, but I know we're going to probably talk about this later, but collaboration will get us there, and understanding what needs to be true and just getting those in place. Yeah, that's my little addition to the what's the challenge there.
That's great. I mean, what you just said, half of Ontario's GDP, the question that came to mind is this going to be recovered through rates, electricity prices, or I'm not sure. So now let's hear from Jonathan in terms of commercial realities.
Yeah, the commercial reality is daunting. I do think if I take a step back, the reality is that this needs to be financed. Like when we talk about, 400 billion, all of these things are major infrastructure and investment. And, we do finance those over a very long period of time. The like debt load and what that means to individuals is surmountable. I think a lot though about the tools that have allowed the economy that we have today to exist. And the challenge that we often face when we're trying to solve climate change, or honestly anything else in the world of sustainable finance, is that sometimes people think that because you're doing a good thing, or because this seems so obvious that we can solve it all with equity, right? That there's some venture capitalist out there that's going to put down a giant check and that's going to solve the problem, where just companies are going to just finance these things straight from their balance sheet. And the reality is that like we need every financial tool possible to make this efficient, effective, fast. To the Kathleen's point of hurrying up, I often joke that again, I'm a theoretical physicist that works in climate. Like there are all sorts of technologies that seem really cool, and the one that I think is the most impressive and the most important technology in solving this is financial technology. Not like fusion is amazing. If anyone on the call has any role in financing fusion, there's a great Canadian company that like it needs more capital. But financial technology solutions like what power purchase agreements and long-term contracts did for solar and wind, getting that to work for every other technology is absolutely critical. But those systems work because they're hyper efficient, because the policy regime becomes exceptionally clear. The obligations and needs of corporates become exceptionally clear. And so we can get rid of all of the other risks, anything that is not the exact things that we need to solve for, and then make those hyper efficient financings highly leverageable. The difference between something that's fully contracted and, if you think about that 400 billion, turning that into 30-year debt at a government cost of funds or as close to that as possible means that the actual debt service is exceptionally low. But doing that requires policy certainty. It requires a complete understanding of how these things are going to get repaid and all of the other things that allow financings for other things to be as efficient as they can be.
Jonathan, you spoke a bit about the financing tools and the various aspects the different levers that perhaps we can pull. I want to just zoom in on that as well and bring in Leslie, because Leslie, I know we had this conversation probably about 2 years ago, that as we inform this debate and the various policy levers, the need to better understand the implications, as we talked about, is so fundamental, but the impact is significant and very multidimensional, and the cost of getting it wrong is even higher. So we've been talking about what tools and what frameworks might be helpful. Are you able to speak to where we got to and some of the examples that we have adopted recently that may have contributed to the debate in a positive and evidence-based way?
Yeah, I would echo that. Like, there's a definite need for these like robust decision-making tools. We've spent a lot of time understanding what can be achievable, what are the targets that companies and governments should be putting forward, and now it's how do you execute? What's a robust, informed plan? These tools, you need tools that integrate systems and portfolio level thinking and not siloed analysis. When I spoke of that energy or electric system operator, that's just the electric system, but what happens in the electric system will matter to what needs to be done on the fuel side of the energy system. They work hand in hand. So we've used a wide range of tools in our work with clients to understand that, what needs to be true in the impact of policy. The ranges from like project and portfolio level tools on investment analysis, like capital allocation tools, scenario analysis that looks at what are your resilient projects, what are likely to be no regret investments, over a long period of time under different macroeconomic scenarios. So that's portfolio level thinking. And that is very helpful to really inform the what needs to be true on individual business cases and how policy impacts those individual business cases. But we've also worked on developing these energy system modeling capability. We have an asset we call Energy Systems Pathways that allows us to analyze, the supply demand dynamics within the Canadian energy system, model outcomes and technology requirements under emissions constraints and policy scenarios. So that allows us to assess sort of like what decarbonization technologies are critical. What is the understand the investment pathways or the pathways that are needed for the unique circumstances of individual provinces, individual sectors, and energy end users. And to Jonathan's point about how this will all be financed, we are looking, and your point, Nicole, about the ratepayer, we're looking at this from a lowest cost optimization perspective and not just a what is the quickest, but also the quickest with the lowest impact to the public, basically, because it will be financed. It will have to be funded through several levers. So we work with governments and energy producers to understand the policies that can accelerate decarbonization under the unique circumstances and understand what are the investments that are needing to be made. It's our approach to generating an informed opinion rather than projections and views that are really based in high level assumptions. It's really getting into the details and saying what are the trade-offs and I keep coming back to what needs to be true, but also what are if this happens in this sector, if a certain amount of electric vehicle adoption happens over here and it impacts electric system load, then there's less pressure on renewable fuels and clean technology over here. But what if it doesn't at the same time? So there's a lot of scenario analysis we're building into that.
Thanks, Leslie. And I want to also pick on the point about trade-offs as well. I mean, some of these are hard decisions, as we talked about. If we go back to your 400 billion, if that is going to be recovered through rates, that's going to contribute to significant rate increases in energy bills, and how that is going to affect inflation and people affordability, and what that means for economic in terms of, are we looking at potentially another recession if that happens too fast without managing the impact? There are lots of trade-offs, perhaps. I want to also just recognize that these decisions are hard decisions. So I want to come to Kathleen as well in terms of what you're seeing in light of those trade-offs and the reality that our public sector colleagues are facing, and what are some of the learnings that you might be able to share?
Yeah, so I mean, I think absolutely we hear the term energy trilemma a lot, right? There's the trade-offs between decarbonization and sustainability, reliability and resiliency of the system, which of course is challenged now. Our 100-year storms are sort of every other year or every year in some instances. And then you've also got the affordability question. And I think there is kind of this, how do you balance the energy transition across those three corners of the energy trilemma? On the same wavelength, there's also this need, though, as I think Jonathan and Leslie and you're saying, Nicole, that to streamline the timeline. So we've got to go faster. We've got to balance all of those three things, but also go faster. We have to reduce capital costs, and we have to ensure and improve investor certainty. So it's sort of everything everywhere all at once. And that's the reality of the challenge facing policymakers today. We did a scan of other jurisdictions. What are others doing that's effective? And we actually customized some of the lessons learned to the Canadian context. And one of the findings out of that work was very concretely, you asked about levers before, Nicole. So it's one lever in the system that we think needs some attention, which is impact assessments. So when we talk about, everything everywhere all at once and getting things built, one of the big kind of hurdles to get through is the Impact Assessment Act. And we've seen some Supreme Court decisions and attention here and rulings around unconstitutionality of some aspects of the Impact Assessment Act. And so there's a bit of attention to streamlining it. But we also, in our work at PPF, have said let's just fix impact assessment. Let's leave the act aside for a moment and actually look at what's happening in impact assessment and how can we streamline some of this. And when we looked at other jurisdictions, we found two solutions that we think are incredibly have high potential for impact here. So one is that the statutory deadlines on parts of the process could actually be opt-out rather than opt-in. So in other words, if a timeline expires, the project goes forward as opposed to being stalled in a process for months and months on end, sometimes years on end. So that's one. It kind of gives greater certainty to certain types of projects in the system. And I think that speaks, Leslie, to your point on scenarios and uncertainty. We want to bring more certainty to certain kinds of projects that we know are needed to enable the transition. The second solution that we found is the need to identify potential energy corridors as go-to areas for certain kinds of investment. This has been done in California quite well. We think this could apply in particular to the transmission system in Canada and in each province. And so you'd have essentially, like you have with when you build a home, you'd have pre-approved sites for certain kinds of projects that enable streamlining of the timelines around those projects. And when you think about in Canada, we need to build over 40,000 kilometers of transmission systems, high voltage transmission, to enable the energy transition that wraps around the globe. That's the distance of what needs to be built. So it truly is what we call the project of the century. And so any streamlining, I mean, in addition to financial tools that have been mentioned, any streamlining that we can do around impact assessments, we believe could be incredibly impactful.
That's great. We talked about financial tools, economic tools, and some of the potential examples that we can learn from. I'm also seeing in the chat that there's a couple of questions I'm going to quickly draw your attention to. The first one, thank you, James, for sharing that. What do you think is in the way of SMDs, small modular reactors, beginning to replace reliable wind and solar and provide sustainable baseload power? Is this a question that perhaps, Jonathan, you would like to start with? And
well, I can kick off, but I'm going to just borrow heavily from what the other panelists just said. Like, we need everything, everywhere, all at once. And so there is no replacing wind and solar. There's a need to massively scale them up. Yes, we still need baseload generation. Yes, you need like hardening of the generation capacity so that we can meet demand. But the reality is that, at some point, we also need to variabilize load in a more effective way. I talk a lot when we think about hydrogen. The winning hydrogen electrolyzer is whatever one can reduce their capital cost to the point that it can run whenever there's supply. Because we're going to have variable supply of power. The question is who can use it effectively. And, everything else is going to need to pay a premium for the ability to have 24/7 clean electricity. I do think there's a lot that needs to be done in order to accelerate SMRs from, a solution to, something that can be deployed more widely. We are really at the early innings with, the work that OPG is doing, and that moving forward is still a beacon globally. But we need to go from SMRs for grid purposes to SMRs for remote purposes to SMRs actually being deployable within plant gates, like what is being considered in the US, to be able to meaningfully decarbonize heavy industry. And so, I would definitely, I almost think, get rid of the word or from the vocabulary. Like it is an and in so many of these instances. And so, there are no silver bullets. There's a need for all of these technologies in massive scale. And it's really a question of how do we scale all of them.
thanks, Jonathan. And I know there are many different technologies. As Leslie, we've been looking into our tools. I think the number of technologies is growing and learning about their viability and where they are in their maturity. Are you able to speak to how we incorporate the different technologies and what you've learned from doing this exercise?
Yeah, I mean, I do want to validate everything that John said. To me, it's an and. There's a place for small modular reactors in specifically for me, heavy industry is where we see that. And you mentioned remote. that makes a lot of sense as well. But heavy industry it's a difficult task to decarbonize there. And so there will be a need there. I don't see replacement of wind and solar. They are low cost, particularly solar, a generation that's just very it's not like you can't toggle it on and off. You have to be moving, or you have to take it where you can get it. But it is a very good source of supply, and not one we would push out of the system for higher cost options. So to me, there's a place for them, and I think it's definitely an and. Yeah, we've talked about on our side with just different technologies, to decarbonize the system. We're obviously talking about RNG, renewable natural gas, hydrogen, carbon capture across the board. We're looking at and carbon capture across the board in terms of electricity generation, oil and gas operations, steel and cement plants. So in all forms of where there's heavy industry that's going to have trouble replacing fuels for clean fuels. So those are like really those big rock technologies that we're going to be looking at, but there's a whole bunch of energy efficiency, electrification, smaller. They're not small rocks when you add them all together, but individually there's a lot of individual components, individual technology adoptions that need to happen along the way that we look at, from processing, heat consumption, to just general energy and electricity supply. So that's yeah, we have a database. I think we have around 200 technologies that we've captured in our database that are kind of mapped to different industries and sectors and existing generation or energy supply types that we can pull from when we do our modeling. So it's a really important component of it, and SMRs is one of those.
Thank you, Leslie. And I'm wondering, Kathleen, are you seeing any or making any observations in terms of all the different technologies, what Canada particularly has strength in perhaps, and that would contribute to our competitiveness or our pace in the energy transition?
Yeah, that's an excellent question. Canada has a very good geography and an even better geology. So we have a lot of natural advantages, no pun intended, with regards to our critical minerals, our oil, our natural gas, our uranium supply, our access to clean electricity and water and 3 oceans and a north-south corridor. We've got a lot here. And we have a lot of emerging and innovative technologies that are uniquely Canadian as well. I think about pumped storage or air compressed storage or long duration energy storage, hydrogen. There's a lot happening in Canadian clean tech that we should be excited about. When I think about what is happening, though, and I guess more to your question, Nicole, on what I'm observing, I have the privilege of traveling across Canada and talking to people about their challenges. And I think when we look at the Canadian energy transition, it's really important to focus on the provinces and the unique provincial realities that are at play. And so in addition to the technologies and these kind of natural assets that we have as a country, we do have major discrepancies and differences between the provincial realities that are faced. And we go back to that trilemma of affordability and resiliency and decarbonization. It looks really different in each province. You think about a place like Nunavut, for instance, that runs on diesel. There's 0% clean electricity in Nunavut. Alberta's at about 11% non-emitting energy sources, falling towards the bottom of the OECD, even behind countries like Russia and China. We have 3 provinces and 2 territories that fall behind the OECD average. So when you look at how those technologies are adopted in each of those contexts, it needs to really acknowledge the natural and geographic differences in each province. And I think that is a critical point when it comes to rolling out policy. And one of my colleagues the other day reminded me that the provinces have been writing electricity system standards and policies for over 100 years. And on the federal side, a lot of this is actually relatively new. And when we look at what does federal policy look like vis-a-vis the provinces? I think we're really learning that there needs to be this sort of cooperative federalism. As naive as that sounds, it's really about leveraging Canada's federalism to our advantage. And there's a huge opportunity there. And I'll just end with an example because I think we saw this roll out in the clean electricity regulation process where, there was a need for this extensive consultation at the provincial level. So we're seeing that roll out now and some acknowledgement of those realities. And I think that's critically important to enable a smooth transition.
Thank you, Kathleen. That's great. Kind of a broad view also in specific areas where we're seeing progress. And I do want to come back to the Q&A as well, because there's more questions there I think are really great. Jeff, thank you. What are your thoughts about the biggest challenges of carbon markets, given the need for carbon markets to finance projects needed, but with the recent story in the media about Shell selling phantom carbon credits and the overall challenges about the trustworthiness of carbon markets today? I'm going to come to Jonathan because you touched on this already earlier.
Yeah, so I think it's really important to distinguish between voluntary and compliance carbon markets. I joke, like, the biggest misnomer is calling it carbon markets. It's not one market, it's 97 markets. It's, the equivalence of every varietal of grape is a different wine when you come down to it. So trust in voluntary compliance markets, absolutely essential. People need to know that a ton is a ton is a ton is a ton. The Shell example with Quest is one that I'll, without diving into too much, main thing is it's actually highly transparent. It was very well known that there was a double crediting. It is an incentive. And I think one of the challenges that we face is that compliance carbon markets are a policy tool to drive decarbonization. And so the question is, how are we achieving those objectives, and how do we best align structures within those compliance carbon markets to incentivize investment? That is one structure that was used, was double crediting, to say, okay, if you need this to work and at today's price it doesn't, how do I just give you more volume to incentivize an early adopter? The carbon contracts for differences, the carbon offtakes done by the Canada Growth Fund, these are an alternative solution and one that generates movement very quickly. The other that I'll point out is all the clean fuel markets that are sometimes called a carbon market as well. BCLCFS, the new CFR. The way I would frame it is those are highly levered carbon pricing markets. So we talk about, okay, if LCFS in California is $75, what does that make economical? But the fundamental reality is, because it's based on a level of stringency on the decarbonization of fuels, that $75 is not a $75 price on carbon. It's around a $7.50 price on carbon, because it only applies to 10% of the carbon within the market until the market improves, but it's a $75 price for solutions. So smart policies that can differentiate between the cost that people pay, which I know we use headline numbers for carbon, but very rarely is anybody ever paying that full headline cost of carbon on their full carbon footprint. They're paying it on percentages. The reality is that number that we talk about, that's the solution price, if we can construct the market well, and the cost that people pay is actually fractions of that. And so having highly levered carbon pricing to incentivize solutions, absolutely essential. I think, yes, we do need to talk about this in a way that is not just the language of polluter pays. It's not fundamentally what these markets are doing. It's not how they're constructed. It's not what we're trying to use them for right now. We're trying to make economic solutions to incentivize the investments that we need now in order to drive near-term decarbonization in a way that's aligned to getting the system where it needs to be.
Thank you, Jonathan, for sharing that insight. It also just occurred to me that what we've been talking about earlier about building awareness around these impacts is not just in terms of understanding from a decision maker's point of view, but also what we're doing with the public in terms of building that awareness. Leslie, I also want to come to you on that specifically, because I know you've been advising clients on deploying capital on that specific questions when it comes to carbon market. Have you seen the effectiveness in some of these policy tools in shifting clients' mindset when they're thinking about allocating capital?
Yeah, I could not have said it better than Jonathan. I think around like it's really just a tool to get this project the right return on investment to get it over the line. And so it makes a massive difference to whether these things will go ahead, just for the certainty of the return. But right now, the uncertainty of what that, let's say regulatory specifically, the regulatory market would fetch for pricing is not, and that's an OBPS credit that you can generate under there. It's a CFR credit that you can generate, and the regulatory construct of a province by province system where Alberta can only, any credits generated under their tier system can only be traded with other tier participants at this point draws a very firm box around how much value that these can actually generate for a project that then can get it over the line. So I don't know that I can add anything more than what Jonathan said, to be honest. These are just tools to make it happen, and really the uncertainty right now of what that value will be in the future, and the lack of transparency on that market right now, because it's not an established trading market. There's newly been some trading, like I think it's on NGX or C, something that there were some trading things, but they're not highly liquid. There's not a lot of certainty in those forward curves for regulatory carbon credits, or even like, I'm going to leave voluntary because that's not where I end up playing or spending a lot of time. But it's really like you end up trying to see if you can make the project work with 0 carbon credits, and a lot of the time you can't. And so then you say what needs to be true, and that gets brought forward to the policy makers to say, can we make a deal? Can we do something here that will bring this over the line? Because it's not about trying to fetch the highest price in the market. It's just the minimum that needs to make this viable.
Thank you, Leslie. I don't know whether Kathleen, you have anything to add. I also am seeing a question in the Q&A that would be really great for you too.
Okay, maybe before we shift there, I'll just add one layer to what Jonathan and Leslie have said, which is bringing the public along, the governed along on this journey. So in terms of certainty, I mean, when we looked at the data recently, Angus Reid put out a poll, 42% of Canadians oppose a price on carbon. The majority of Canadians, however, agree with the 2030 net zero targets. Like there is, economists say that a price on carbon is the most efficient way to get there. We've talked about financing the transition, but there is a major communication and understanding challenge in the public realm. I think this kind of goes back to your previous question, Nicole, about public realities as well. And that cannot be ignored. This is a long-term game. And if the public is not on side with the steps that are taken in the energy transition, we're not moving things forward. And so I just think it's a really important layer to this equation.
That's very well said, Kathleen. Important point. We have to win the hearts and minds of everyone who is going to be affected by this energy transition in different ways. So the questions that in the Q&A I thought would be great for you. Thank you, Ron, for the question. Aside from federal and provincial funding programs, what are municipal best practices in funding sources for energy transition and climate resilient programs in Canada or across the world?
Great question. I don't know that I'm best placed to answer this because we actually don't do a ton on the municipal level, but I will say on the climate resiliency side of things, there is an incredible need for collaboration at all 3 levels of government, particularly around those challenges. And actually, Paul Wells recently had this amazing conversation with Olivia Chow about this and the resource constraints at the municipal level. And I think it comes back to the question of who is responsible for paying for climate resilience and who's caught holding the bill at the end of the day. And municipalities with their competing budget lines and immense challenges on the climate resiliency front. You think about flooding, you think about critical infrastructure threats, you think about even cyber threats or social services or public services that a municipality is responsible for are not well equipped, nor are they well capitalized to deal with the climate resiliency challenge. So I think I would love to hear solutions from others, and I'm sure there are many. I know Federation for Canadian Municipalities is doing a ton of work in this space, but it is a massive, massive challenge when it comes to access to capital.
Yeah, like if I can rip a little bit, like Kathleen's former employer, Mars, actually spent a lot of time on municipal impact investment funds and looking at what could you do to drive decarbonization. And like I think there's a theme in some of the Q&A and some of the chat that I think it really touches on, which is like that the investment needed. We talk so much about energy systems. We talk about so much about grid, and the fundamental reality is that like there is no grid, right? Like Canada's really big, and so the grid breaks down, but it's not all interconnected. It is a huge collection of loads of generation of all of these things, and so many of them occur in municipalities. And so thinking about every building within that municipality, how are you going to get the support that's needed to decarbonize it? Whose balance sheet is it going to sit on? Can that be something like what the city of Toronto used to do, or I think they still do around, what in the US is called PACE, the Property Assessed Clean Energy. So encumbering via tax rolls rather than encumbering at the debt level and saying, look, the building is the problem. It's not the owner of the building. The building needs to decarbonize. How do we actually encumber that building and know that we're able to draw on the funds needed? How do you look at, some of the small scale collaboration that can be really meaningful? There are concepts like smart blocks where you begin to look at not just microgrids, not just how do you scale some energy storage, but how do you do things like gray water reuse in a collective way? Municipalities are so much closer to where that kind of small collective can occur. Honestly, sometimes it feels like a BIA level or a like community watch level is where some of these solutions can occur, but enabling those, creating policy regimes that allow these things to happen, making it so it's just as easy to put energy storage on your building as it is to build a laneway, unit might be, these types of solutions are really meaningful, and then creating whatever incentives can be used to generate some of that collective benefit. Because if you find ways to reduce the aggregate need for building out grid, or the need to install a bunch of transformers, the need to dig up everything to build new water catchment and new solutions for water levels, if things can be done by incentivizing it, there's a massive cost avoidance that could really be generated, and municipalities are well poised to harvest those benefits in exchange for providing those incentives to the community members.
Yeah, I would add one thing here that Jonathan, you've made me think of, is one of the ways that we can manage grid rather than overbuilding is at that municipal level, that city community level. If we're going to see a significant growth in EV chargers when they charge, and incentivizing how you manage load on the grid. This is true about when you run your dishwasher, when you run your dryer, all of those larger appliances. Those are really local things that can be done that don't have to be federal and provincial policies. They're really municipal and community, especially like I'm in Calgary and Max is my main provider. When they send out suggestions, we have water restrictions that we have to worry about right now. It's not any different than, rather than getting into a restriction situation in electricity, we can just incentivize different behaviors.
And maybe to take one more step on that, just because it is one that comes to mind, is like if you look at zoning and you look at the requirements on things like parking lots for office buildings, those are incentives that we are creating that drive behavior. If you told, return to work is a controversial topic, everyone's pushing at different levels, and every company has a different need. But when you incentivize someone to have a large parking lot, you're incentivizing them to tell their employees that they need to drive to work. When you're doing that, you're actually creating load demand on the system. And so thinking about where those policies actually make sense, mm-hmm. and whether or not they're generating the outcomes that you want, and thinking about not just, where the revenue sources come from, but the costs that they create indirectly. It's actually, obviously it's not easy, but it's an interconnected system.
I will also note just one point that you made, Jonathan, on cost avoidance. it's incredibly hard to value cost avoidance in the current system. And so financial tools, you mentioned impact investing, social impact bonds, there are a plethora of unique financial tools that have been developed in that space now that can actually add a dollar value to cost avoidance. And when it comes to climate resiliency in particular, that is crucial to unlock basically a whole new market around those solutions.
I also want to come back to Jonathan. You made a point about there's collective benefits. Have you seen when working with municipalities is one of the ways that you mentioned that could be effective in kind of almost getting to a scale when this makes sense? Have you seen any models that has worked well as you explore this path in terms of investments working with the municipalities?
I mean, so the cheeky answer is no. The more realistic answer is yes. There are some examples where London did to create a structure essentially where they were making these investments, had a hurdle rate, collected a bunch of private investors and said, okay, we can de-risk some of these things. When Kathleen talked about the challenge of cost avoidance, creating a structure where if you know you're going to incur those costs and you can pay for those benefits, you can, as a municipality, do so with potentially a much lower cost of funds on that, the time value of money than a lot of individual companies, individual operators. And so there is a spread to be made. There's actually not to say municipalities should start seeking profits within it, but there's an ability to, take advantage of that cost differential if you're willing to ascribe reality to the cost avoidance, which I think when you look at long-term planning in most municipalities, those are treated as real, right? You need to account for the growth in those costs and say, how are we going to actually address them? Look, the hard answer though is nobody likes the idea of taxation in exchange for providing collective benefits. It's not a super politically popular idea, but on some of these things, like that is the answer that we will have to go to for certain things where you just can't ask individuals to bear the full costs. I go back to the energy retrofit example, and like we've done a lot of work around retrofits at the bank, but the hard one is retail, where, if you said, and I don't live in this house anymore, but my old house, it was about a $30,000 retrofit. If you wanted to get natural gas out of that house, and if you wanted to go to the best level of efficiency, because I had a dryer, I had a water heater, I had a furnace, I had a stove, I had a barbecue, all of those things need to be changed over. And the ability for individual households to just absorb that much debt, not everyone's 30,000, but you're talking $10,000 to $20,000 a household to drive those changes, even though the benefits are there, the balance sheets are strained at the household level. And it's not easy to always collectivize that debt and take it all up at a municipal or provincial or federal level. But it is the most efficient means of financing that when you do it. If you can take the debt service cost and do that at the lowest cost, individuals are never the cheapest, version of that. Government balance sheets are. And so if there are ways to do that, the benefits are massive, and you can even still take a profit if you really want to. That's what banking is. But if you're not willing to take a profit, you can still do a lot with that delta.
That's a really great perspective when it comes to thinking about not just the supply side in terms of what we need to invest in to provide the capacity, but also on the demand side, what can we practically influence, what can we incentivize at the user level to really make this for everybody to be able to do their bit to contribute to this journey. I realize that we are very quickly at time. There's still some really great questions in the chat that we won't be able to get to. I do also see comments about a part 2 potentially being suggested. So I think we're very much looking forward to continue this dialogue. And thank you all very much, our panelists, for sharing your perspectives. I think this is a journey that we all have a role to play. And I will urge everybody who's tuning in today, thank you for your time, but also hope you will have the opportunity to reflect on some of these conversations and your own journey so far, and share with somebody else as well, because I think we need to continue to learn and continue together this journey together. So thank you all very much.
Thank you.
Thanks,
Thank you for
everyone.